$890,000 in medical debt, despite insurance, despite paying $14,000 a year in premiums, despite an $8,500 out-of-pocket maximum. Meet James Sullivan, age 58, senior software engineer, 30 years of continuous employment, six-figure salary. And most importantly, he had the gold plan, the kind of insurance they tell you makes you safe. Then, stage 3 cancer diagnosis. 6 months later, James wasn't just fighting for his life, he was drowning in $890,000 of medical debt. This isn't a story about lacking insurance. This is forensic analysis of the coverage gap. The moment your good insurance meets the AI-driven denial systems of 2026. If you have a job, a mortgage, and a health insurance card, you are exactly one diagnosis away from becoming risk outlier number 402. James Sullivan, 58, making $145,000 per year, $340,000 in retirement savings. He was the model of stability until the diagnosis. In the 2026 healthcare market, insurance companies aren't just processing claims. They're using AI algorithms to hunt for documentation errors and deny coverage. For James, it started with a single letter, a denial for immunotherapy. The reason? Not medical necessity, but a missing key word in his doctor's notes. That was the first leak. Then the dam broke. By month 18, zero retirement savings, $890,000 in medical debt, bankruptcy at 59. This is the $2.1 million life value tax. I built a free assessment to help you see if your coverage is a safety net or a trap. Link in the description. Now, the 3 traps that liquidated James's financial life. Trap 1: the coverage gap. In 2026, insurers are denying nearly 1 in 5 in-network claims. For high-cost services like oncology, that rate is even higher. James wasn't a person to his insurer, he was risk outlier 402. His gold plan had a 2026 individual out-of-pocket maximum of $10,600. He thought that was his worst-case scenario. He was wrong. The out-of-pocket maximum only applies to covered services. The AI scanned his doctor's clinical notes for documentation gaps. It found 7 precision errors in his treatment regimen. Each resulted in a denial. His oncologist recommended immunotherapy. The algorithm flagged it as experimental, not covered. His doctor appealed, twice, both times denied. Treatment cost $340,000. James paid out of pocket, drained his 401k, survived the cancer. Then the algorithm denied coverage for follow-up scans, not medically necessary, another $180,000. Then it denied second-line treatment when the cancer came back, experimental, another $270,000. Total denied $890,000. Because these were denied, they didn't count toward his $10,600 out-of-pocket maximum. James was personally liable for the full retail cost of his survival. The word good insurance is meaningless when an AI decides your life isn't worth the expense. Trap 2: the income cliff. James was too sick to work. After 90 days, he was laid off. To keep his insurance while unemployed, he had to pay the full COBRA premium. Cost $2,400 per month. In Austin, that's not just a mortgage, that's a 3-bedroom house in the suburbs, paid every month just to keep access to the same doctors. Not for treatment, not for medications, just for access. James had zero income, $2,400 in monthly premiums, plus the $10,600 out-of-pocket maximum for covered treatments. He was spending over $12,000 per month just to stay in the system while unable to work. Month 12, COBRA ended. He switched to marketplace insurance, $1,800 per month. Lower premium, but his oncologist was now out of network. New doctor, treatment delays. The cancer progressed during the transition. Month 16, he couldn't afford the marketplace premium. He dropped coverage. Now uninsured, hospitals charged him full retail price, 3 times what they charge insurance companies. The sicker you get, the less you can work. The less you can work, the more healthcare costs. The more it costs, the faster your savings disappear. Trap 3, the retirement drain. Let me show you the math nobody explains. James withdrew $340,000 from his 401k at age 58. Early withdrawal penalty, 10%. Income tax, 30%. Total loss, 40%. $340,000 became $204,000 after taxes and penalties. But here's the real cost. If James had left that $340,000 untouched, growing at 7% for 7 years until age 65, $340,000 becomes $545,000. Then, from 65 to 85, that would grow to $2.1 million. James didn't just spend $204,000 on medical bills. He spent $2.1 million. He spent his 60s, 70s, and 80s. This is the life value tax. You pay to survive today. The cost is your future, all of it. James saved for 30 years, did everything right. 1 illness, 18 months, 0 retirement, $890,000 in debt. The healthcare system doesn't just bill you for today's treatment. It bills you for every future year you won't have financial security. What can someone in James's situation actually do? I'm showing you patterns that work in 2026. Pattern 1. The CPT Code Audit. The hospital's bill isn't final. It's an opening offer. James hired a medical billing advocate to perform a line-item audit of CPT codes, current procedural terminology. They found unbundling, where a single procedure is billed as 5 separate, more expensive codes. They found upcoding, where a routine 15-minute consult was billed as a complex 60-minute crisis. They found duplicate charges, procedures never performed, medications never received. Hospital bills contain an average of 40% errors. By challenging the codes, they reduced the $890,000 debt by 65%. The rule? Never pay a bill without an itemized CPT breakdown. If you don't see the codes, you aren't looking at a bill. You're looking at an estimate. Pattern 2. Strategic bankruptcy. James had perfect credit for 30 years. He was terrified of bankruptcy. But here's the forensic reality. James was 58, 0 retirement, $890,000 in debt. He would have to work until age 95 to pay it off. Chapter 7 bankruptcy allowed him to discharge the medical debt while protecting his house under Texas homestead laws. Filing fee, $1,500. Credit score, 720 became 580, rebuilt to 680 in 18 months. Debt? Discharged. People who view bankruptcy as an engineering reset rather than an admitting defeat recover 3 times faster. Why? Because they're not paralyzed by shame. They're executing a plan. The system tried to delete him. He used the system's own tools to survive. Bankruptcy isn't the end. It's a legal reset, a strategic financial amputation to save the organism. Pattern 3. The Healthcare Directive. Here's what people who avoid this trap do before they get sick. They build a healthcare financial directive. 3 components. Component 1, coverage audit. They don't ask, what's my out-of-pocket max? They ask, what's excluded? What counts as experimental? What's the lifetime cap? Most people discover their good insurance has a $1 million lifetime maximum. 1 cancer diagnosis and you hit it. Component 2, healthcare savings segregation. In 2026, the HSA family contribution limit is $17,000. By maximizing the HSA during healthy years, you have cash to cover the out-of-pocket maximum without touching retirement. Component 3, treatment decision framework. Before diagnosis, they decide at what point do we stop treatment to preserve financial survival. That sounds brutal. It is. But the alternative is bankrupting your family for 3 extra months of life. The people who survive this financially set boundaries before emotion takes over. The reality check. James did everything the system told him to do. Good job, good insurance, retirement savings, responsible choices. Then he got sick, and the system performed an 18-month wealth liquidation. $340,000 in retirement, gone. Financial independence, deleted. 30 years of compound growth, erased. The healthcare trap isn't about personal responsibility, it's about systemic design. Insurance companies use algorithms to deny claims. COBRA costs more than rent. Early 401k withdrawals trigger 40% tax penalties. Every piece is designed to extract maximum wealth from people at their most vulnerable. James survived cancer, but the billing department nearly killed him anyway. Next episode. Remember Linda from episode 5A? She lost $890,000 in her divorce at age 50. But what if Linda had known at age 42 what she learned at 50? Same person, same divorce, 8 years of warning. The forensic breakdown of preparation versus reaction. Episode 5B, The Same Life, Earlier Information. Subscribe so you don't miss it. Drop a comment. Which trap hit hardest? 1. The coverage gap. 2. The income cliff. 3. The retirement drain. Just the number. Assessment link in the description. 3 minutes. Shows you which traps you're exposed to. This is Alex Observes. I observe,